Look at the major indices today and see record highs across the board. The traditional wisdom is to buy a passive S&P 500 index fund, sit back, and let the broader economy go to work for you. But beneath that surface, the unified stock market has fractured. According to macro strategist Jim Bianco, we are no longer looking at a single cohesive equity market. We are looking at two entirely separate realities operating at the exact same time. This diagram breaks down the reality of the S&P 500. It splits the index into two distinct groups. On one side, you have a massive block of 459 traditional companies. On the other, a tiny, hyper-focused cluster of just 41 businesses directly tied to artificial intelligence. Watch how this tiny sliver behaves. Despite making up less than 10% of the index by count, those 41 AI-related companies expand to command roughly half the total value of the entire market capitalization. 459 companies equal one half, 41 companies equal the other. You have to look back over 150 years to find a market this lopsided. The last time capital concentrated this heavily around a single theme was during the railroad boom of the late 19th century. Navigating this environment requires what marathon runner Eliud Kipchoge calls vitamin N, the discipline to say no. For investors, that means resisting the comfort of the most crowded trade in finance. When you buy a standard index fund right now, you aren't actually diversifying your risk across the American economy. You are placing a massive, highly concentrated bet on a single technology sector maintaining its momentum. This chart shows projected tech hyperscaler capital expenditure. By 2027, AI infrastructure spending is scaling up to $1.2 trillion, roughly 3.6% of U.S. nominal GDP, creating a massive demand shock. But that trajectory cannot hold indefinitely. As end users wait for actual productivity gains to justify the costs, these massive spenders will be forced to throttle back their capital expenditures. That sudden reduction in spending ripples through the broader economy. The initial trillion-dollar cash injection floods the system, keeping prices elevated and creating a stubborn, sticky inflation that refuses to drop back to the Fed's 2% target. When the tech trade eventually exhausts itself, that sticky inflation leaves the Federal Reserve paralyzed. They cannot cut interest rates to rescue tumbling stock prices while inflation runs hot, leaving investors trapped. For over a decade, investors relied on a predictable playbook from the Federal Reserve. Markets were spoon-fed policy directions through detailed forward guidance and dot plots that telegraphed future rate decisions months in advance. Under the leadership of Kevin Warsh, the Fed has systematically gutted its policy statements and eliminated forward guidance. Central bank officials are no longer giving the market a comforting narrative to trade on. Portfolio managers and retail traders alike are now forced to read the raw economic data and make their own real-time assessments. Investors who spent years trading on central bank rumors are now operating blind. That widening gap in reaction time between seeing raw data and waiting for a Fed official to explain it will cost the unprepared massive amounts of capital. Without a guaranteed narrative of an over-concentrated index fund is fully exposed. When the data turns sour, the market correction will be sudden, and there will be no central bank press conference to soften the blow. As the mega-cap tech trade fractures, capital is already migrating. The new playbook involves taking profits from the handful of massive companies at the top and flowing that liquidity down the market capitalization ladder. That money is actively seeking cheaper valuations. It's moving into equal-weight mid-cap indexes, international equities that have long been ignored, and specific biotech stocks that have spent years consolidating and are finally breaking out. This rotation is also sweeping into digital alternatives. Capital flows are showing sustained technical momentum in crypto assets, particularly in Bitcoin and high-beta altcoins like Solana, which are setting up for long-term runs. Even within the artificial intelligence sector, the focus is shifting. Smart money is moving away from the companies building the expensive language models and into the businesses utilizing those models to solve complex physical problems. Take Axon, for example. By integrating AI targeting systems into non-lethal, remote-operated drones, they are completely removing police officers from the line of fire. It is a practical application of new technology that drives real-world utility. The capital gains of the last 2 years went to the engineers building the AI engine. The wealth generated over the next 5 years will go to the operators using that engine to reshape the physical world. Yet capturing this rotation requires being in the market to begin with. Right now, 38% of American families have absolutely zero exposure to the equity market, completely missing out on this capital cycle. A newly launched federal program called Trump Accounts aims to bridge that gap. The initiative provides a $1,000 seed investment directly to the next generation of American children, invested by default into low-cost index funds. By placing real capital in the hands of families who have historically been left behind, the program fosters financial literacy and proves the mechanical power of long-term compounding over an 18-year horizon. The days of parking your money in a top-heavy index and ignoring macroeconomic data have passed. Surviving the back half of 2020s means tracking capital flows in real time, tearing up the old central bank playbook, and securing your position in the hidden half of the market before the two realities finally collide.